What I'm about to show you isn't speculation from talking heads or political commentary from either side of the aisle. This is forensic accounting, the kind that sends executives to federal prison. I've spent 3 decades building white-collar criminal cases, and I can spot the difference between aggressive business tactics and outright fraud within minutes of looking at financial statements. The case we're dissecting today crosses that line so dramatically that even seasoned prosecutors were shocked when they first saw the evidence. We're talking about systematic deception involving some of the most famous properties in America, fake numbers that inflated net worth by nearly $500 million, and a scheme so brazen that it continued even after investigators started asking questions. The document sitting in front of me is 73 pages long. It's called a Statement of Financial Condition, and it was submitted to multiple banks over a span of nearly a decade. Every single page is signed. Every number is supposedly verified, and according to the evidence that's now part of the court record, almost every major asset listed in this document was deliberately overvalued. When I say overvalued, I don't mean by 10 or 15%, the kind of optimistic assessment you might expect from an aggressive businessman. I mean overvalued by 200%, 300%, in some cases even higher. This wasn't rounding up to make the numbers look prettier. This was manufacturing an alternate financial reality. Let's start with the most absurd example because it perfectly demonstrates the level of deception we're dealing with. The penthouse apartment that serves as the primary residence spans 3 floors of one of New York's most famous buildings. In the financial statements submitted to Deutsche Bank, Ladder Capital, and several other institutions, this apartment was listed as being 30,000 square feet. That's not a typo on my part. 30,000 square feet. For context, that's bigger than most people's entire office building. It's roughly the size of a professional basketball court times 3. Based on this massive square footage, the financial team applied a price per square foot calculation that valued the apartment at $327 million, making it theoretically the most valuable residential property in New York City history. Here's the problem that unraveled the entire scheme. The apartment is not 30,000 square feet. It's not even close. The actual size, according to the building's original architectural plans, the floor plans filed with the city, and the condominium documents that are part of the public record, is 10,996 square feet. Think about what that means for a moment. This wasn't an estimate that turned out to be slightly off. This wasn't a good faith disagreement about how to measure square footage. Someone looked at an 11,000 square foot apartment and wrote down 30,000 square feet on a legal document. That's not a mistake you make by accident. You don't accidentally triple the size of the place where you've lived for 20 years. The evidence gets even more damning when you look at the pattern across the entire portfolio. Take the office tower at 40 Wall Street, a 72-story building in Lower Manhattan. Professional appraisers hired by the banks valued this property at approximately $200 million based on its age, its occupancy rates, its rental income, and its location. Those appraisers used industry-standard methodologies. They looked at comparable sales. They analyzed the actual cash flow the building was generating. They came up with $200 million. But on the financial statements going to lenders, the same building was listed at $525 million. How did they justify more than doubling the appraised value? They manipulated something called the capitalization rate, which is essentially the expected rate of return on a real estate investment. In real estate valuation, if you want to make a building appear more valuable, you lower the cap rate. You tell the bank that investors would accept a lower return because the property is so stable, so desirable, so low risk. The internal emails that surfaced during discovery show the valuation team doing exactly this. They treated a 72-year-old office building with vacancy issues like it was a brand new Class A skyscraper in the most prime location imaginable. They artificially suppressed the cap rate to generate a number that was more than twice what the actual market would support. That's not aggressive accounting. That's fabrication. But perhaps the most legally problematic example involves a sprawling estate in Westchester County called Seven Springs. This property includes a massive mansion, guest houses, and over 200 acres of rolling hills and wooded land. Here's where the scheme becomes impossible to defend. The defendant told two completely contradictory stories about the exact same piece of land to two different entities. To the tax authorities, he claimed the land was permanently restricted from development because of a conservation easement. This allowed him to claim a massive charitable deduction and pay substantially lower property taxes. The argument was simple. You can't build anything here, it's protected forever, therefore it has minimal value. But simultaneously, to the banks he was borrowing money from, he valued the exact same restricted land at $291 million by claiming it had enormous development potential for luxury homes. You cannot tell the IRS that land is worthless because you're prohibited from developing it, and then tell Deutsche Bank that the same land is worth hundreds of millions because of its development potential. That's not a difference of opinion. About valuation methodology. That's two mutually exclusive representations about the fundamental nature of the asset. It's fraud, plain and simple. The conservation easement was a legal document he personally signed. He knew the restrictions, he knew what they meant, and he made the calculated decision to ignore those restrictions when presenting his net worth to lenders. What makes this case even more devastating for the defense is that we now have testimony from insiders about how these numbers were actually generated. The former chief financial officer, a man who worked inside the organization for years, sat in a courtroom and described under oath what he called reverse engineering the financial statements. Here's how it worked according to his testimony. Instead of adding up the assets to determine total net worth, they would start with the net worth number they wanted to hit. The defendant would look at a draft of the financial statement and say it was too low, that he needed to be worth more than that for an upcoming loan negotiation or for personal reasons. Then the finance team would go back and find ways to inflate individual assets until the total reached the target number. This is the opposite of how legitimate financial reporting works. In normal business, you evaluate your assets honestly, you add them up, and whatever number you get is your net worth. You don't get to pick your net worth first and then work backward to justify it. That's not accounting. That's creative fiction. And we have handwritten notes from executives showing exactly this process, with scribbled calculations and margins trying to figure out how to boost asset values to reach predetermined goals. The consequences of this case extend far beyond the courtroom. The Attorney General is seeking financial penalties that exceed $350 million, representing the ill-gotten gains from years of fraudulent lending. But the truly devastating remedy is the request for a permanent ban on serving as an officer or director of any New York corporation. If granted, this would effectively remove the defendant from control of his own company. An independent monitor has already been installed with complete access to all financial records and transactions, the kind of oversight typically reserved for organized crime operations. The business empire built over decades is being systematically dismantled by court order, and the final judgment could accelerate that process dramatically. The numbers don't lie, and in this case, the numbers tell a story of deliberate, sustained fraud at the highest levels.